Hello and welcome to Linear Talk, and I'm delighted to have back in the studio Theron from Eschler Asset Management. Theron founded Eschler back in 2012. Prior to that, he was an analyst at Indus Capital, a long-short equity manager set up by an ex-Soros fund manager. Between 2000 and 2008, he was at Morgan Stanley, and he started his career at Goldman Sachs as a financial markets analyst there. So welcome back.
Thank you for having me, Colin.
Last time we discussed your investment philosophy for your kind of approach to investment management. Now let's kind of dig a little deeper and talk about those kind of ideas in practice, if you like. So first off, what do you do differently to other managers?
The first is that as a value investor, I look to absorb market volatility. So there's a curious characteristic of most financial investors in that they behave the opposite of the typical bargain hunter at the supermarket. So if you like ice cream and you're looking to get a good deal, and you see Haagen-Dazs 2 for 1, you're probably going to make that trade. Instead, the financial market participant tends to buy more as the price rises and sell more as the price falls. So at the top, they're all in, and at the bottom, they're out. And I think last time we talked a little bit about how the market gets very emotional at times, and it's this behavior that creates that volatility. And I think it's why a value-oriented strategy coupled with a long-term time horizon works. And I think it's why artificial intelligence or machines can't really arbitrage that away. So I structure my fund to basically be able to deploy capital as a bargain hunter. And so what does that mean? It means avoiding leverage. You have to be able to survive first.
Yep.
It means patiently building a watch list, only investing in beaten down shares and with recovery potential, and waiting, if necessary, a long time for the value to be recognized. It means being unpopular at times. It's buy low and sell high. Maybe it sounds easy, but it's not.
Yeah, but the opposite of what the trend follower does, which is buy high and hopefully sell higher.
Exactly.
So the value element is clearly integral and very important. So what is it that you look at when you're looking for those sort of value propositions?
Yeah, you're right that for a business approach to investing in recovery situations, valuation is very important. And not only does the discount to private market value have to be substantial, but the absolute multiple has to be quite low. What I'm really looking for is shares that can double over a period of 3, 4, 5 years through a combination of earnings growth and valuation expansion. So I like to compare, if you could sort of distill it into one ratio, I like to compare a business's operational profitability, so EBIT, as a percentage of enterprise value, so market value plus debt, subtract out the cash.
Yep.
And this focus on enterprise value in the denominator naturally biases me towards businesses that have stronger balance sheets, so less debt, and they tend to have a lot of cash.
So I guess this is what sort of drives out those low PE values where actually that's a signal that there's a problem because you're looking for the strong cash flow.
Exactly.
You're looking for companies that are just out of favor rather than ones that might be about to go out of business.
Exactly. And what I like to look at is this so-called pre-tax earnings yield. It's similar to the cap rate that a property investor might use, and I like to invest at least at a 12 to 13% pre-tax earnings yield. That equates to about a 12 to 13 times PE. Ideally, it's a 15% earnings yield would be better. For a very attractive business with good growth prospects, that can earn good returns on capital, I would rarely pay less than a 9 to 10% earnings yield. So that's a mid-teens PE. And for cyclical businesses, which is part of what I do, I'm calculating a normalized earnings power, so over a full cycle. And by the way, this approach is an absolute approach, so I don't change what I'm willing to pay based on changes in interest rates. John Templeton said that he liked to find shares or buy shares that traded at 5 times what he thought they could earn in 5 years. And if you kind of do the math, that's what I'm doing.
Yeah, so it's the net present value of the future PE, if you like.
Exactly,
yeah.
exactly.
Now that's an interesting example. Would this be a good time to maybe drill down into a sort of real example of this kind of investment process and practice? Could you talk us through a for instance, perhaps?
Absolutely. So I don't know if we have a slide up there. Oh, there we are. Good. So Geospace Technologies is an oil services company based in Houston. Market cap is about $200 million. The price per share is 15, and there are about 13 million shares outstanding. It's a leading manufacturer of wireless seismic data acquisition systems that help oil and gas companies improve their productivity and reduce maintenance costs. They also pioneered what's called permanent well monitoring systems, PRM systems, which help large offshore oil and gas companies to characterize their seabed reserves and extract more of the oil in place. And this company is also unique because they're the only company in this data acquisition segment, seismic data acquisition segment, that doesn't compete with its customers. The management's been working together for the better part of 2 decades. They have a good track record. They've compounded retained earnings at about 13% over that time, and with zero goodwill. So a well-managed business. Just for a little context, the company won 2 very large of the reservoir monitoring contracts back in 2013 and 14, about $190 million. So for this company, that's a lot. Made a lot of money. And it was about that time that I first came across this company in a screen I was doing, and I was looking for cash-rich companies trading at low multiples of cash flow. And it looked almost too good to be true, and as it happens, it was. And this is, I think, a good example of where only relying on screens can lead you astray. I was lucky enough to trade out of it with a small profit after understanding the lumpy nature of these contracts. Anyway, a couple years later, I took notice of the company again. This was after the oil price had collapsed. Energy downturn was well in course, and the shares, meanwhile, traded down to a large discount to book value, and book value had been written down a lot as well.
Double whammy.
Exactly. But unlike many companies in this industry, Geospace has a very strong, pristine balance sheet. They have about $68 million of liquidity between cash, no debt, $30 million of a revolver that they haven't accessed. They have a tax receivable on their balance sheet. So this is a very big, I think, competitive advantage for a company like this in a cyclical industry. And it's why I have conviction that Geospace ultimately will show a strong recovery. So valuation. I value the company on normalized earnings power. The cycle goes through big swings. And so what I do is I looked at a period before the global financial crisis when oil was in a recovery period, averaged about $60 in 06, 07. Incidentally, that's where I think oil kind of has a clearing price today. And back then, the company earned about 25% return on invested capital, and the multiple of pre-tax earnings was about 15 times. If you apply that 15 times multiple and that return on capital to the current capital base of the company, you get a $35 share price. So it's going to take some time, but let's say...
So where is it trading now?
15.
15, so a doubling over that period.
Over 3 years. So that's sort of the 30% odd compound return that I'm looking for. And another cross-check would be, if you just look over the 20 years the company's been listed, the average price to book has been about 2.2 times price to book. And that is also a high 30s share price. Risks, the obvious risk here is spending on seismic has ground to a halt. They have no PRM contracts, which is the real juice for this company, in their pipeline this year. But I think because of industry depletion rates, a recovery is inevitable. The oil and gas companies will have to start spending again. This is a productivity-enhancing service that the company provides. And to give a sense, both peaks of the last 2 cycles, this company traded at 4 times price to book value. So I think at this price, well into the downturn, you're paid to wait. So.
Fantastic example. I'm afraid that's all we had time for today. Theron, thank you so much for really giving us a good deep dive into that value-based investment process. Hopefully we can have you back on the program again in the future.
Once again, Colin, thank you very much.
Pleasure.